How do you calculate long-term capital gains? If you have ever wondered how to calculate long-term capital gains, especially in real estate investing, you are in the right spot. Understanding this process can help you save money on taxes when selling your investment properties. So, let's break it down step by step. First, you need to determine the cost basis of your property. This is usually the original purchase price plus any capital improvements you made while owning it. For example, if you bought a property for $200,000 and spent $50,000 on renovations, your cost basis would be $250,000. Next, you will want to find out the selling price of the property. Let's say you sold it for $100,000. To find your capital gain, subtract your cost basis from the selling price. In this case, for $100,000 minus $250,000 equals $150,000 in capital gain. Now, to qualify for long-term capital gains, you must have held the property for more than 1 year. This is important because long-term gains are taxed at lower rates than short-term gains, which are taxed as ordinary income. The tax you owe on your capital gain will depend on your tax filing status and your total taxable income. Long-term capital gains tax rates are generally tiered. You could pay 0%, 15%, or 20% based on your income level. For instance, if you are married and filing jointly, and your taxable income is up to about $96,700, you may pay 0% on your long-term gains. If your income is between $96,701 and $600,050, you will likely pay 15%. If your income exceeds $600,050, you will pay 20%. When calculating long-term capital gains in real estate, remember to adjust your cost basis. This includes any depreciation you claimed during ownership and certain closing costs, as these can affect your taxable gain. If you decide to use a tax-deferred exchange, known as a 103,001 exchange, you can defer paying capital gains tax by reinvesting the proceeds into a similar property. This will adjust your new cost basis as well. To summarize the practical steps for calculating long-term capital gains, first, determine your adjusted cost basis by adding your purchase price and improvements, then subtracting depreciation and certain closing costs. Second, find the net sales price by subtracting selling expenses from the sale price. Third, subtract your adjusted cost basis from the net sales price to get your capital gain. Fourth, identify your taxable income, including the gain, to find your applicable long-term capital gains tax rate. Finally, multiply the capital gain by the tax rate to calculate the tax owed. Holding your property for more than 1 year is essential to benefit from the lower long-term capital gains rates. This can significantly reduce your tax liability compared to short-term rates. Understanding these calculations can help you make informed decisions in your real estate investments.